All right, welcome introductory students to today's explainer. We're jumping right into Chapter 11, which is all about the financial preparation you need for entrepreneurial ventures. You know, it's a crazy statistic, but most startups actually don't fail because they have a bad idea. They fail because of poor financial preparation. And hey, if you don't have a business background, absolutely do not worry. We're going to demystify all that complex financial jargon today and really build out your ultimate entrepreneurial financial toolbox so you can beat those odds.
Okay, so here's our roadmap for today. We'll start with core financial statements, move into preparing financial budgets, check out pro forma future projections, dive into key decision-making tools, and finally wrap up with measuring success with ratios.
Let's kick things off with Section 1, Core Financial Statements. This is all about recording the past and the present. Imagine you've just opened up a local bakery. At the end of your very first week, you need to ask yourself this exact question to really understand your venture's financial position. Financial information basically pulls together everything happening in your business, and to make sense of all that activity, we use our first major tool.
And that tool is the balance sheet. I want you to think of it like a snapshot taken on one specific day. It clearly details exactly what your firm owns, which we call your assets, and it balances that against what you owe to your creditors, which are your liabilities. The difference between those two things, well, that's your equity. That's the true value that actually belongs to you, the owner. This right here forms the golden equation of accounting. Assets equal liabilities plus owner's equity.
To break that down a bit further, assets are separated into two categories based on how liquid they are. Your current assets are things like the cash in your register or the flour sitting in your bakery's pantry. They're highly liquid and ready to be used up quickly, usually in just one business cycle. Contrast that with your fixed assets. These are your heavy, long-term investments. Think of a giant commercial oven or the actual land your bakery sits on. Both are assets for sure, but they serve very different operational purposes.
Now, if the balance sheet is a snapshot showing your wealth frozen in time, the income statement is more like a movie showing your performance. It measures the change in your firm's position over a specific period of time. You take your gross sales revenues, subtract the expenses of producing your goods or services, and the number you're left with at the bottom is your net income. This movie tells you the most exciting story of all for an entrepreneur. Did your hard work actually result in a profit?
The third core statement is the cash flow statement, and honestly, this one is absolutely critical. Why? Because you can actually be profitable on paper according to your income statement, but still go totally bankrupt if your customers haven't paid you in actual cash yet. This statement tracks real, cold, hard cash, moving across three distinct areas: your daily operating activities, your investing activities, like buying new equipment, and your financing activities, like taking out a business loan.
Moving right along to Section 2, Preparing Financial Budgets. This is where we start planning for the future.
A budget is seriously one of the most powerful tools an entrepreneur can leverage. Building an operating budget is a highly logical, step-by-step process. I mean, think about it. You can't possibly know how many materials to buy or how many shifts to schedule until you estimate how much you're actually going to sell, right? So, it absolutely must start with forecasting your future sales. Once you've got that sales forecast nailed down, you cascade down to build your purchase requirements, then your production budget, and finally your expense budget.
Alongside that operating budget, a cash flow budget is absolutely vital. Think of this as your early warning radar system. By tracking the exact timing of when cash enters and when it leaves, management can pinpoint cash problems way in advance. It gives you the breathing room to secure a financing loan weeks before a crisis hits, rather than, panicking at midnight when payroll is due the next morning. All right, Section 3, Pro Forma Future Projections. Let's look at putting it all together.
So the phrase pro forma sounds super intimidating, but it is literally just fancy Latin for what if. Pro forma statements are just your future income statement and balance sheet. The math here is incredibly straightforward. You just take your current reality, which is your beginning balance sheet, and you add your budgeted changes. Those two together equal your pro forma projections. This lets you forecast exactly what your financial position is going to look like at a specific date in the future.
Now for Section 4, Key Decision-Making Tools. This is about making those tough choices. As your venture gets up and running, you are inevitably going to need to make some very calculated decisions, things like setting your pricing or deciding whether it's time to expand. And this brings up the classic entrepreneurial hurdle, identifying exactly when you stop losing money and finally start making a profit. To figure this out, we rely on something called break-even analysis.
The break-even formula uses what we call a contribution margin approach. Let's make this tangible. Back to our bakery. Say you sell a customized cake for $10, and it costs $4 in materials to make. That $6 difference is your contribution margin. It basically contributes to paying off your rent, your utilities, and other fixed costs. This formula helps you find the exact volume of cakes you need to sell where your total revenues perfectly equal your total costs. At that point, you're left with zero profit, but crucially, zero loss.
It's really helpful to look at this break-even point visually, too. You have a thick green line representing fixed costs, and notice how they stay totally flat no matter how much you produce. Rent is rent, right? Then the dark blue line represents your variable costs, which climb steadily as you bake more goods. Now, the magic happens right where the solid blue sales line crosses that red dashed total cost line. That precise intersection is your break-even point. Every single thing sold past that intersection, that is pure profit.
Now, beyond daily sales, you're going to face long-term choices, and those require capital budgeting. When you're deciding on major long-term assets, like maybe buying a second bakery location, these methods help you look past simple math. Because of inflation and interest, $1 today is worth more than $1 tomorrow. Net present value and the internal rate of return are advanced tools that account for this time value of money. They help you decide if a multi-year investment will truly pay off over the long haul.
Finally, we've reached Section 5, Measuring Success with Ratios. Let's talk about evaluating the health of your business. Ratio analysis lets us evaluate our overall business health by showing relationships among different financial statement accounts. We group these into a few specific categories. Simply put, solvency is your ability to survive long-term debt. Liquidity is your ability to pay today's bills. Profitability represents your actual earnings from sales. And efficiency measures how well you're putting your assets to work to generate those sales in the first place. Let's compare two of these key ratios in practice just to see how they work. You measure short-term solvency with the current ratio, which just divides current assets by current liabilities. Let's say you get a ratio of 1.76. That means you have $1.76 in liquid assets for every single dollar of short-term debt. If you're our bakery owner, a ratio of 1.76 means you can comfortably cover this month's flour orders and rent. You can contrast that with your long-term financial risk using the debt-to-worth ratio, which tells you how heavily leveraged you are compared to the owner's actual investment.
So there you have it. We've built your complete Chapter 11 toolkit today. From the past-looking balance sheet to future-looking pro forma projections, budgets, and efficiency ratios. Now that you've got this powerful financial preparation demystified, how will you apply these concepts to confidently steer your own venture? Think about it. Which of these specific tools do you think will truly make the difference between just surviving and actually thriving in your first 90 days? Thanks so much for joining me on this explainer, and I really look forward to exploring more with you next time.